Did you know that around 90% of retail Forex traders lose money? Understanding risk management could be the key to flipping those odds in your favor. Risk management is not just about limiting losses, it's about maximizing gains while minimizing exposure. It's about being realistic about the market's unpredictability and taking steps to insulate yourself from its volatility. When you master risk management, you'll start to see consistent profits and long-term success in the market. It's not just about making money, it's about keeping it too. Many successful traders will tell you that risk management is the key to their success. It's not about being lucky or having a magic formula. It's about having a solid plan and sticking to it. When you combine risk management with a solid trading strategy, you'll be unstoppable. But here's the thing, risk management is not just important for traders, it's essential. Without it, you're leaving yourself open to massive losses and financial ruin. You might as well be playing roulette, hoping that Lady Luck will smile on you. In the world of Forex trading, risk management is not an afterthought. It's a core component of your overall strategy. It's what separates the winners from the losers, the pros from the amateurs. So, if you want to make it in this game, you need to take risk management seriously. Mistakes in risk management can be devastating. One of the most common mistakes traders make is over-leveraging their accounts. They think they can make a quick buck by betting big, but all they are doing is setting themselves up for a massive loss. Another mistake is neglecting stop-loss orders. Traders think they can manually close a losing trade, but we all know how that works out. Emotions take over, and before you know it, a small loss turns into a massive one. Some traders also fall into the trap of revenge trading. They lose a trade, and then they try to make up for it by making an even riskier trade. This is a recipe for disaster. Then there are those who neglect diversification. They put all their eggs in one basket, thinking they can ride a hot streak. But what happens when that streak ends? Many traders also misunderstand position sizing. They think it's just about making a big trade, but it's about so much more than that. It's about managing your risk exposure and maximizing your returns. Some traders also fail to adjust their risk management strategy as market conditions change. They stick to the same plan, even when the market is telling them otherwise. Another mistake is not having a clear risk-reward ratio. Traders get caught up in the excitement of a potential trade and forget to think about the potential risks. Then there are those who don't adapt their risk management strategy to their trading style. Day traders need different risk management strategies than swing traders, but some traders think one size fits all. Traders also make the mistake of not regularly reviewing their risk management strategy. They set it and forget it, only to realize that it's not working for them anymore. Some traders also neglect to consider the carry trade risks. They think they're making free money, but they are not accounting for the potential risks. Market changes can also catch traders off guard. They think they are prepared, but when the market shifts, they are left scrambling to adjust. Fear and greed are also major obstacles in risk management. Traders get caught up in the emotions of a trade and make impulsive decisions. Then there are those who don't prioritize risk management. They think it's an afterthought, something to be done when they have time. But here's the thing. Risk management is not just about avoiding losses, it's about maximizing gains. When you have a solid risk management strategy, you can focus on making money, not just limiting losses. So, how do you avoid these common mistakes? It starts with setting proper stop-loss levels. This is not a one-size-fits-all solution. You need to consider the market conditions, the trade setup, and your overall risk tolerance. Position sizing is also crucial. You need to calculate the right size for your trade based on your account size, risk tolerance, and market conditions. Diversification is key. You need to spread your risk across different trades, assets, and time frames. You also need to prioritize risk management. Make it a part of your daily routine, not just an afterthought. Adapting to market changes is also essential. Stay up to date with market news, analysis, and trends. Having a clear risk-reward ratio is vital. Make sure you know what you're risking and what you're expecting to gain. Regularly reviewing your risk management strategy is also crucial. Stay flexible and adjust your strategy as needed. Now, I want to share a powerful risk management secret with you. It's something that can dramatically improve your trading results. One of the most effective ways to improve your risk management is to use a risk-reward ratio anchored to your entry price. This means that you're not just looking at the potential gains, you're also considering the potential losses. Let me give you an example. Let's say you're trading a currency pair, and you set a stop loss 20 pips below your entry price. You're also targeting a take profit 40 pips above your entry price. In this scenario, your risk-reward ratio is 1 to 2. You're risking 1 pip to make 2 pips. This is a powerful way to manage your risk and maximize your gains. So, how can you apply this to your own trading? Start by anchoring your risk-reward ratio to your entry price. Then, adjust your stop loss and take profit levels accordingly. Let's summarize what we've discussed today. Mastering risk management is essential for consistent profits and long-term success in the Forex market. Common mistakes in risk management can lead to devastating losses, so it's crucial to avoid them. Effective risk management strategies include setting proper stop-loss levels, calculating position sizes, diversifying trades, and adapting to market changes. Prioritizing risk management and regularly reviewing your strategy is also vital. And finally, using a risk-reward ratio anchored to your entry price can dramatically improve your trading results. What do you think about risk management? Share your thoughts in the comments below. If you want to learn more about trading strategies, check out our video on the best Forex trading strategies for beginners. And don't forget to subscribe for more valuable content on Forex trading and risk management.